Good morning, everyone. Today, we're diving into a transformative period I call the triple convergence. This isn't just about one technology, but the powerful intersection of artificial intelligence, our evolving energy infrastructure, and the physical world upgrade. As you can see from the diagram, these three pillars embodied AI, energy infrastructure, and kinetic hardware are coming together to reshape our reality, leading to an infrastructure supercycle unlike anything we've seen before, especially between 2026 and 2030. The year 2026 marks a pivotal inflection point. We're transitioning from what I call brain building, focused on cloud training and large language models, creating a volume shock in software to economy-wide deployment. This shift will see vision language action models spread to edge devices, creating a deployment explosion. The key insight here is that we're moving from a software-focused volume shock, reminiscent of the dot-com era, to a high-intensity value shock concentrated in electrical engineering and physical assets. This means that economic improvement really kicks in, not when AI is just built, but when it's widely adopted and spreads throughout the economy. This unprecedented AI demand is already crashing head-on into significant physical grid limitations. Data center capacity is projected to double by 2030, necessitating massive capital expenditure. We're seeing a jump from about 100 gigawatts to 200 gigawatts, with data center electricity consumption in the U.S. expected to reach 12% by 2028, up from 4.4% in 2023. The AI revolution is forcing a wholesale reinvention of our power infrastructure. We're no longer just utilizing grid slack. We need entirely new generation. Consequently, grid connection wait times now exceed 4 years in primary markets, and this transformation will require a staggering $3 trillion in investment by 2030. Amidst these challenges, stationary storage is scaling faster than automotive adoption. Batteries are rapidly becoming the critical bottleneck asset, bridging the gap between intermittent renewables and the immense power density required by AI. Tesla energy deployments, as shown here, are projected to reach approximately 1 terawatt-hour by 2030, representing an 88% compound annual growth rate from 2022 to 2025. Why is storage so crucial? AI rack density is soaring from 10 kilowatts to 100 kilowatts per rack, a load the existing grid simply cannot handle without massive behind-the-meter buffering. Battery storage is now a mandatory process technology for the AI economy. Tesla, specifically, has undergone a great pivot between 2024 and 2026, fundamentally redefining its core value. In April 2024, a strategic restructuring, including a 10% workforce reduction, was enacted to fund critical projects like Dojo and end-to-end neural nets. By October, the We Robot event unveiled the Cybercab, notably without a steering wheel or pedals. Early 2025 saw a major strategy shift, abandoning the Model 2 cheap car in favor of a dedicated robotaxi focus. And finally, by January 2026, Austin became an inflection point with the removal of safety drivers from the robotaxi fleet. This is a true metamorphosis. Tesla has transitioned from a hardware manufacturer judged by unit volume to a robotics firm judged by mean miles between interventions. This pivot has significant financial implications. Energy storage revenue is poised to eclipse automotive sales by 2029. While automotive revenue is projected to remain relatively flat, energy revenue is expected to surge, hitting $77 billion by 2029, potentially surpassing automotive. More importantly, energy is the clear profit driver. Energy margins are around 30%, significantly higher than auto margins of 17 to 18%. In fact, in the first half of 2025, energy contributed 23% of Tesla's total profit, despite accounting for only 13% of revenue. This highlights the strategic importance and profitability of their energy segment. The Austin rollout by January 2026 signals the true era of unsupervised mobility. Tesla has removed safety drivers from Austin Robotaxis, deploying these unsupervised vehicles alongside a broader monitored fleet. The vehicle is the Cybercab, designed without a steering wheel or pedals, embodying a pure vision-only end-to-end neural net strategy, which fundamentally differs from the geo-fenced LiDAR approach of competitors. For competitive benchmarking, while Waymo has impressive weekly ride numbers using LiDAR and sensor fusion, leading to high asset costs, Tesla's Austin Pilot focuses on vision only, targeting a significantly lower asset cost of under $30,000 per unit. This low asset cost strategy is a major differentiator. Robotaxis fundamentally transform vehicle economics from ownership to utilization. Private vehicle ownership suffers from a massive utilization gap. Vehicles are driven only about 4% of the time, remaining idle for 96%. In contrast, a robotaxi model aims for 60% revenue-generating utilization, with only 40% allocated to charging or idle time. This leads to a massive valuation shift from one-time sales to recurring revenue. Projected gross margins for robotaxis are 60% to 80%, akin to SaaS businesses, far exceeding the 15% to 20% of auto manufacturing. ARK Invest projects that the robotaxi business alone could represent 90% of Tesla's enterprise value by 2029. Beyond transportation, Optimus presents an even larger opportunity within the $100 trillion global labor market. To put that in perspective, the global transport market is roughly $10 trillion. Optimus Gen 2 is targeting a price point of $20,000 to $30,000, with a production goal of 1 million units per year by late 2026. Currently, about 1,000 units are deployed in Tesla factories, primarily for tasks like battery sorting. The labor substitution economics are compelling, replacing a $25 an hour human worker with a $25,000 capital asset yields a net present value of approximately $200,000 per robot, highlighting a massive potential for efficiency gains. However, this kinetic revolution comes with its own set of supply chain constraints. The 2026 cycle is a value shock concentrated in electrical engineering and materials, exposing critical bottlenecks. In actuation, we face dependencies on rare earth magnets, with China dominating processing. For power infrastructure, copper and transformers are critical, with U.S. lead times extending to 3 to 6 years. And in edge silicon, inference compute relies on proprietary silicon from companies like NVIDIA and Tesla for vision language action processing. Addressing these bottlenecks will be crucial for scaling the physical AI future. This brings us to a significant valuation divergence. Is Tesla a declining automaker or an emerging AI platform? The automotive trap suggests declining margins, a projected 7.7% delivery decline in 2025, and intense competition from players like BYD. From this perspective, a 292x price-to-earnings ratio is considered ultra-expensive for a carmaker. However, the platform premium narrative paints a different picture. ARK Invest projects a $2,600 price target by 2029, with robotaxi accounting for 90% of enterprise value. The energy supercycle provides a high-margin floor around 30%, indicating a clear path to a $3 trillion market cap by 2026. This dual perspective is essential for understanding Tesla's complex valuation. For investors, capturing this S-curve growth requires disciplined accumulation. As this chart illustrates, a monthly dollar-cost averaging strategy into Tesla stock has neutralized the valuation reset volatility experienced in 2022 and 2024. The reality is that Tesla's stock frequently resets as it transitions between growth phases. Investors must stomach the lows during these production ramp-up periods to truly capture the insanely fast S-curve expansion that characterizes these transformative technologies. However, this path to 2030 is not without critical risks. Regulatory bottlenecks are a major concern, with EU regulations restricting unsupervised autonomy and NHTSA investigations into full self-driving safety continuing. Geopolitical dependency also poses challenges. Foreign entity of concern rules complicate battery supply chains, and dependence on Giga Shanghai amidst US-China tensions is a significant risk. Finally, there's technical gambling, the vision-only versus LiDAR debate. If Tesla's vision-only approach fails critical edge cases, the entire robotaxi thesis could collapse against competitors like Waymo, which rely on LiDAR. The ultimate outcome of this convergence is a shift from labor scarcity to intelligence abundance, redesigning both urban and domestic life. In urban areas, we'll see the end of parking, repurposing up to 90% of land currently used for idle cars into parks, housing, or commercial spaces. Domestically, automation of household chores will lead to a massive time reallocation, freeing up human time for creative and social activities. Fundamentally, the cost of physical labor and transport trends towards the marginal cost of electricity, promising an era of unprecedented efficiency and new possibilities. In summary, the 2030 outlook points to a structural shift towards physical AI. As I like to say, We are moving from brain builders to economy-wide beneficiaries. The era of the driver-led Tesla is ending. The era of the autonomous grid has begun. The cycle ahead is a value shock concentrated in electrical engineering and robotics. The winners will be the owners of the process technology, those who control energy, data, and actuation. The ultimate result will be a profound upgrade of our entire physical world. Thank you.